Trading in the Zone by Mark Douglas, book summary in English. Introduction. Mark Douglas sets the stage by addressing a common problem among traders: the struggle to achieve consistent profitability despite having technical knowledge. He argues that trading success is 80% psychology and only 20% strategy or analysis. Douglas highlights a key issue. Many traders believe that their knowledge of indicators, patterns, or market analysis will automatically lead to success. However, they often experience fear, hesitation, overconfidence, or revenge trading, which leads to inconsistent results. He introduces the idea that the market is unpredictable and random to a certain degree, yet traders often try to impose their expectations on it. This creates frustration and emotional stress, leading to self-sabotage. Douglas emphasizes that the real challenge in trading isn't the market, it's the trader's mindset. He promises that this book will teach traders how to develop a disciplined, objective, and probabilistic mindset, which is the key to long-term success. Key takeaways from the introduction. 1. Strategy alone is not enough. Trading psychology is the missing piece for most traders. 2. Markets are unpredictable. You can't control them, but you can control your reactions. 3. Emotions ruin consistency. Fear, greed, and hesitation cause losses. 4. A probabilistic mindset is key. Thinking in probabilities helps traders accept risk and avoid emotional mistakes. Trading in the Zone, Chapter 1. The Road to Success: Fundamental, Technical, or Mental Analysis. In this chapter, Mark Douglas challenges the traditional belief that success in trading comes purely from fundamental or technical analysis. Instead, he argues that a trader's mindset is the true key to success. Concepts. 1. The 3 approaches to trading. Fundamental analysis, studying economic data, news, and financial reports to predict market movements. Technical analysis, using charts, indicators, and price patterns to identify trading opportunities. Mental analysis, psychology, understanding how your thoughts, emotions, and behavior impact your trading decisions. Douglas argues that while fundamental and technical analysis provide useful tools, they do not guarantee success. Many traders lose money, even when their analysis is correct, because they lack the right mindset. 2. Why most traders struggle. Many traders believe that more knowledge, indicators, strategies, or news will automatically lead to profits. They experience fear, doubt, and hesitation, leading to poor execution. Even after a winning streak, traders may become overconfident, causing reckless trades. He explains that these emotional cycles are predictable and repetitive, and unless a trader masters their psychology, they will continue to struggle with inconsistency. 3. The reality of the market. The market moves independently of any trader's expectations. No one can predict exactly what will happen next. The key is to think in probabilities, not certainties. 4. The shift to a probabilistic mindset. Successful traders accept that they don't need to be right all the time. They focus on risk management and playing the probabilities over time. The goal is consistency, not perfection. Key takeaways from Chapter 1. 1. Mental analysis is more important than fundamental or technical analysis. 2. Knowing the market doesn't guarantee success. Your mindset does. 3. Traders must accept that the market is uncertain and focus on probabilities. 4. Fear and overconfidence create self-sabotaging behaviors. Trading in the Zone, Chapter 2. The Lure and Dangers of Trading. In this chapter, Mark Douglas explains why trading is so appealing yet dangerous for most people. He describes how the market provides unlimited opportunities, but also exposes traders to emotional and psychological pitfalls that can lead to failure. Key concepts. 1. The illusion of easy money. Trading attracts people because of the potential for fast, unlimited profits. Unlike a traditional job, there are no limits on how much you can earn. Beginners often believe that with the right strategy, they can consistently win. However, this illusion causes many traders to underestimate the psychological challenges of trading. 2. Trading versus the real world. Douglas explains that trading is different from most professions. In a job, effort equals rewards, e.g. work harder, earn more. In trading, effort doesn't guarantee profits because the market is uncertain. This frustrates traders, making them emotional, leading to revenge trading, overtrading, or impulsive decisions. 3. Freedom without structure is dangerous. In trading, you have total freedom, no boss, no schedule, no rules. However, most people are not wired to handle this freedom without self-discipline. This lack of structure makes traders vulnerable to fear, greed, and impulse trading. Douglas stresses the need for personal responsibility and discipline to create structure. 4. The market is neutral. You are the problem. The market doesn't care about you. It simply moves based on supply and demand. Losing traders often blame the market, the news, or their strategy. Winners take full responsibility for their results and control their reactions. Key takeaways from Chapter 2. 1. The market's potential for unlimited profits makes trading dangerously addictive. 2. Unlike a job, effort does not guarantee success in trading. Mindset does. 3. The freedom of trading can be a curse if you don't have self-discipline. 4. The market is neutral. Your mindset determines your results. Trading in the Zone, Chapter 3. Taking responsibility. In this chapter, Mark Douglas emphasizes that traders must take full responsibility for their results, both wins and losses. He argues that most traders fail because they blame external factors, the market, bad luck, news events, instead of accepting that their own mindset and decisions determine their success. Key concepts. 1. The danger of blaming external factors. Many traders believe the market is out to get them, or that they are unlucky. They blame news, brokers, or other traders when they lose. This mindset leads to emotional trading and prevents them from improving. Douglas explains that the market is neutral. It does not care about any individual trader. The only thing a trader can control is their own behavior and decisions. 2. The power of taking full responsibility. Winning traders accept risk and understand that losses are part of the game. They focus on improving their execution and mindset rather than trying to predict the market. Taking responsibility allows traders to stay calm and objective, leading to better decisions. 3. How lack of responsibility leads to fear and anxiety. When traders don't take responsibility, they feel fear and anxiety because they believe they have no control. This leads to hesitation to enter trades, exiting trades too early out of fear, holding losing trades too long, hoping the market will turn. By owning their decisions, traders can eliminate fear and start focusing on probabilities rather than emotions. 4. The shift to a professional mindset. Professional traders accept full responsibility for every trade, detach emotionally from wins and losses, follow their trading plan instead of reacting impulsively. This mindset shift is what separates consistent, successful traders from amateurs. Key takeaways from Chapter 3. 1. Stop blaming the market. Your mindset determines your success. 2. Taking responsibility eliminates fear and leads to better decision-making. 3. Losses are part of trading. Accept them and focus on execution. 4. Think like a professional. Follow your plan and stay emotionally detached. Trading in the Zone, Chapter 4. Consistency, a state of mind. In this chapter, Mark Douglas explains that consistency in trading comes from having the right mindset, not from finding the perfect strategy. He argues that traders must develop a state of mind that allows them to execute their edge flawlessly, without hesitation or emotional interference. Key concepts. 1. The illusion of certainty. Many traders search for a foolproof strategy that guarantees success. They believe that if they just find the right indicators, signals, or patterns, they will win consistently. Douglas explains that this is a flawed belief. No strategy works 100% of the time because the market is unpredictable. The real key to consistency is accepting uncertainty and thinking in probabilities. 2. Consistency comes from mindset, not strategy. Every moment in the market is unique. There are never two identical setups. The market is a probability game, and the outcome of any single trade is unknown. Traders who focus on probabilities instead of trying to be right develop consistency. 3. Why traders struggle with consistency. Douglas identifies several mental roadblocks that prevent consistency. Fear of losing causes hesitation and missed opportunities. Overconfidence after a win leads to reckless trades. Revenge trading after a loss results in emotional decisions. Random trading behavior, lack of discipline, and no defined strategy. To become consistent, traders must detach emotionally from outcomes and execute their strategy with discipline. 4. The professional trader's mindset. Professional traders accept that losses are part of the game. Focus on executing their edge without hesitation. Do not react emotionally to wins or losses. Maintain a disciplined, rules-based approach. Key takeaways from Chapter 4. 1. There is no perfect strategy. Consistency comes from mindset. 2. Think in probabilities. Accept that you can't predict every trade. 3. Emotional reactions. Fear, greed, overconfidence destroy consistency. 4. Professional traders focus on execution, not on being right. Trading in the Zone, Chapter 5. The dynamics of perception. In this chapter, Mark Douglas explains that traders don't see the market objectively. They see it through their own psychological filters, which are shaped by past experiences, fears, and expectations. These mental filters can lead to biased decision-making and trading mistakes. Key concepts. 1. Perception is subjective. Every trader sees the market differently based on their personal experiences. 2. Traders can look at the same chart and interpret it in completely different ways. A trader's beliefs, emotions, and past experiences influence how they perceive market information. Example: a trader who recently took a big loss might hesitate to enter a trade, fearing another loss. Another trader with a recent winning streak might become overconfident and take excessive risks. 2. How biases affect trading decisions. Douglas highlights several common mental biases that distort traders' perception of the market. Fear of losing causes hesitation or early exits. Overconfidence leads to reckless trading and ignoring risk. Confirmation bias. Traders only see information that supports their belief and ignore warning signs. Revenge trading, emotional trading after a loss, trying to get back at the market. These biases cause traders to make irrational decisions, even when they have a solid strategy. 3. The market is neutral. You must be too. The market has no expectations. It simply moves based on supply and demand. Traders who project their emotions onto the market create self-fulfilling cycles of fear, greed, and mistakes. The solution is to develop a neutral, objective mindset that sees the market as it is, not as they want it to be. 4. Developing an unbiased trading mindset. Accept that you can't control the market, only how you react to it. Train yourself to recognize and remove emotional biases from decision-making. Focus on executing your edge without attachment to individual outcomes. Keep a trading journal to analyze past trades and identify patterns of emotional decision-making. Key takeaways from Chapter 5. 1. Traders don't see the market objectively. Mental biases distort perception. 2. Fear, greed, and past experiences shape trading decisions, often negatively. 3. The market is neutral. Traders must learn to see it without emotional filters. 4. The goal is to develop an unbiased, probability-based mindset. Trading in the Zone, Chapter 6. The market's perspective. In this chapter, Mark Douglas explains that traders must learn to see the market from the market's perspective, instead of imposing their own expectations on it. He argues that the market is completely neutral, and success comes from aligning with its behavior, rather than trying to predict or control it. Concepts. 1. The market has no intentions. Many traders believe the market is out to get them, but this is an illusion. The market doesn't know you exist. It moves based on supply and demand. If you lose money, it's not because the market is against you, it's because you failed to adapt. 2. Traders must stop fighting the market. Losing traders try to impose their will on the market, forcing trades, hoping for reversals. Winning traders observe and react to what the market is actually doing, following trends, respecting price action. Example: a trader might refuse to accept a losing trade and hold on, hoping for a reversal. Instead of adapting, they fight reality and often lose even more money. 3. Thinking like the market. The market is just a series of opportunities, nothing personal. It operates on probabilities, not certainties. The only way to trade successfully is to accept this uncertainty and make decisions based on probabilities, not emotions. 4. Developing a market-centered mindset. Instead of predicting, traders should focus on identifying high-probability setups and executing them without attachment. Stop expecting the market to behave a certain way, just respond to what it's doing. Train yourself to let go of fear, hope, and revenge, and instead think in probabilities. Key takeaways from Chapter 6. 1. The market is neutral. It doesn't know or care about you. 2. Stop trying to impose your will on the market. Adapt to its movements. 3. Think like the market. Focus on probabilities, not certainties. 4. Detach emotionally and respond to the market objectively. Trading in the Zone, Chapter 7 Summary. The Trader's Edge, Thinking in Probabilities. In this chapter, Mark Douglas explains that successful trading is not about predicting the market, but thinking in probabilities. Traders must accept that no trade is ever certain, and that their edge comes from executing a strategy consistently over time. Key concepts. 1. What is a trading edge? A trading edge is a strategy that over a series of trades has a positive expectancy, more wins than losses overall. An edge does not mean every trade will win. It means that if executed consistently, it will be profitable over time. The key is to stick to the process and not judge success based on individual trades. 2. The randomness of individual trades. Each trade is unique. The market conditions, participants, and order flow are different every time. Just because a setup worked before doesn't mean it will work this time. Traders must stop focusing on being right and instead focus on executing their edge consistently. 3. Probability and risk management. Trading success comes from understanding probability. If a setup has a 60% win rate, that means 40% of the time it will lose. Losing trades are not failures. They are part of the statistical edge. Risk management ensures that losses don't destroy the account. 4. Overcoming emotional attachments to trades. Traders who don't think in probabilities feel fear before a trade, hesitation, missing opportunities, regret after a loss, revenge trading, emotional decisions, overconfidence after a win, taking reckless trades. A probability-based mindset eliminates emotional swings because traders expect both wins and losses as part of the process. How to develop a probability mindset. 1. Accept that no trade is guaranteed to win. 2. Focus on executing your strategy, not predicting outcomes. 3. Think in terms of series, e.g. 20 trades, not individual results. 4. Manage risk so no single trade can ruin your account. 5. Detach emotionally. Winning and losing are just part of the game. Key takeaways from Chapter 7. 1. A trading edge means a strategy that works over time. Not every trade will win. 2. Each trade is unique, so predicting individual outcomes is impossible. 3. Thinking in probabilities removes emotional stress and leads to consistency. 4. Risk management is essential. Losses are expected and must be controlled. Trading in the Zone, Chapter 8. Working with your beliefs. In this chapter, Mark Douglas explains that our beliefs shape how we interpret market information and make trading decisions. Many traders fail because they hold limiting or irrational beliefs that cause emotional and impulsive behavior. To trade successfully, one must reprogram their mindset to align with reality and probability-based thinking. Key concepts. 1. Your beliefs shape your trading reality. We don't see the market as it is. We see it through the lens of our personal beliefs. Beliefs about winning, losing, risk, and money influence trading behavior. Negative beliefs, e.g., I always lose, the market is against me, create self-sabotage. 2. The role of fear in trading. Fear comes from beliefs about pain and failure. Traders fear losing because they associate losses with personal failure. This fear leads to hesitation, poor risk management, and emotional trading. Successful traders don't fear losses because they see them as part of the game. 3. Changing limiting beliefs. To become a consistent trader, you must reprogram your beliefs to support a probability-based mindset. This involves identifying limiting beliefs, e.g. fear of loss, need to be right. Replacing them with empowering beliefs, e.g. losses are normal, I only need an edge, not certainty. Training yourself to detach emotionally from individual trades. 4. The power of self-trust. Many traders don't trust themselves to follow their strategy. Doubt leads to hesitation and missed opportunities. Developing self-trust means committing to your process without second-guessing. The more you trust yourself, the easier it becomes to execute your trades flawlessly. How to apply this to your trading. 1. Identify negative beliefs affecting your trading. 2. Adopt new beliefs that align with the reality of trading. 4. Trust your edge and execute without hesitation. Key takeaways from Chapter 8. 1. Your beliefs shape how you trade. Negative beliefs create self-sabotage. 2. Fear of losing comes from limiting beliefs about failure. 3. Changing beliefs is essential for a probability-based mindset. 4. Self-trust is critical. Doubt and hesitation lead to inconsistency. Trading in the Zone, Chapter 9 Summary. The nature of beliefs. In this chapter, Mark Douglas explores how beliefs are formed, how they influence trading behavior, and how traders can change their beliefs to develop a winning mindset. He emphasizes that most traders' problems come from deep-seated beliefs about money, risk, and failure, which cause fear and inconsistency in their decisions. Key concepts. 1. How beliefs are formed. Beliefs are formed from past experiences, emotions, and repeated thoughts. Most of our beliefs develop subconsciously, without us realizing it. If a trader has experienced repeated losses, they may form a belief that trading is hard, or the market is against me. These beliefs then create self-fulfilling prophecies. The trader hesitates, doubts, or overtrades, leading to more losses. 2. How beliefs influence trading decisions. Positive beliefs lead to confidence, discipline, and consistency. Negative beliefs create fear, hesitation, and impulsive decision-making. Example: a trader who believes, I am a consistent, disciplined trader, will act in alignment with that belief. A trader who believes, I always lose money, will unconsciously act in ways that reinforce that belief, e.g., closing trades too early, revenge trading. 3. The role of the subconscious mind. Most of a trader's actions are driven by the subconscious mind, not logical thought. If the subconscious belief is negative, a trader will struggle with emotional control. Changing conscious thoughts alone is not enough. Beliefs must be reprogrammed through repetition and reinforcement. 4. How to change your beliefs for trading success. Douglas provides a method for reprogramming limiting beliefs. 1. Identify the limiting belief. Example: I can't handle losing trades. 2. Challenge it with logic. Losses are part of trading, and even the best traders lose. 3. Replace it with a new belief. Example: losses are normal, and I focus on long-term probabilities. 4. Reinforce the new belief through repetition and action. Journaling, affirmations, reviewing profitable trades. 5. Act in alignment with the new belief. Execute trades with confidence and without hesitation. Key takeaways from Chapter 9. 1. Beliefs shape how traders interpret and react to the market. 2. Negative beliefs, fear of loss, lack of self-trust, cause inconsistency and self-sabotage. 3. The subconscious mind drives trading behavior. Beliefs must be reprogrammed for success. Changing beliefs requires awareness, repetition, and taking action in alignment with the new belief. Trading in the Zone, Chapter 10. The impact of beliefs on trading. In this chapter, Mark Douglas dives deeper into how beliefs directly affect trading performance and explains why aligning beliefs with the realities of the market is crucial for consistent success. He emphasizes that most trading struggles are not due to a lack of knowledge or strategy, but due to internal conflicts between beliefs and market dynamics. 1. The power of beliefs in trading. Beliefs act as filters that shape how we see market information. If you believe the market is difficult, you'll unconsciously seek out information that supports that belief. If you believe the market is full of opportunities, you'll naturally spot setups that align with your strategy. A trader who believes they can't make money will hesitate to enter winning trades. A trader who believes they are disciplined will stick to their plan even after a losing streak. 2. The conflict between winning and fear of losing. Many traders want to win, but they fear losing at the same time. This creates mental conflicts that lead to hesitation, cutting profits short, or revenge trading. Douglas explains that the only way to overcome this is to fully accept the risk of each trade without emotional attachment. Adopt the mindset. Anything can happen. I don't need to know what will happen next to make money. 3. Aligning beliefs with market realities. Winning traders have beliefs like, losses are a normal part of the game. The market doesn't owe me anything. Losing traders have beliefs like, I must win this trade. The market is against me. If I lose, I've failed. The key is to replace fear-based beliefs with probability-based beliefs that align with how the market truly works. 4 steps to reprogram beliefs for success. 1. Awareness. Identify your limiting beliefs. 2. Acceptance. Realize those beliefs are holding you back. 3. Replacement. Adopt new beliefs that support consistency and probability thinking. 4. Reinforcement. Repeat affirmations, journal your trades, and review your thought process daily. 5. Action. Act in alignment with your new beliefs by executing your plan without hesitation. Key takeaways from Chapter 10. 1. Your beliefs filter how you perceive the market. 2. Conflicting beliefs about winning and losing create hesitation and inconsistency. 3. Accepting risk and thinking in probabilities removes emotional attachment to trades. 4. Reprogramming beliefs through repetition and action is the foundation of consistent trading. Trading in the Zone, Chapter 11. Thinking like a trader. In this chapter, Mark Douglas explains the mental framework that separates consistent traders from struggling ones. He focuses on how traders can develop a mindset that aligns with the reality of the market, thinking in probabilities without fear, hesitation, or emotional attachment. Concepts. 1. The core of a trader's mindset. A successful trader's mindset is built on believing in the uncertainty of each trade, trusting that their edge will play out over time, accepting risk without emotional attachment. What does this mean? You don't need to know what will happen next. You only need to execute your edge consistently. 2. The 5 fundamental truths of trading. Douglas lays out these essential beliefs. Truth. Meaning, 1. Anything can happen. The market is unpredictable, and no trade is certain. 2. You don't need to know what will happen next to make money. You only need an edge and consistent execution. 3. There is a random distribution of wins and losses. Even with an edge, losses are inevitable and random. 4. An edge is simply a higher probability of one outcome over another. Trading is a game of probabilities, not certainties. 5. Every moment in the market is unique. No 2 trades are exactly alike. Don't expect the same outcome from similar setups. 3. Probability-based thinking. Most traders focus on the outcome of individual trades. This leads to emotional highs and lows. Successful traders think in series of trades, not one trade at a time. Example, if your system has a 60% win rate, you know that out of 10 trades, 6 will win, 4 will lose. Your job is simply to execute all 10 trades without fear or doubt. 4. The power of consistency. Consistency in trading comes from thinking in probabilities, detaching from individual outcomes, trusting your edge even during losing streaks. 5. Building the trader's mindset. To develop this mindset, you must 1. Define your edge clearly, your strategy. 2. Accept the risk of every trade before entering. 3. Think in probabilities, not certainties. 4. Detach emotionally from each trade. 5. Repeat this process until it becomes automatic. Key takeaways from Chapter 11. 1. Winning traders think in probabilities, not predictions. 2. Accepting uncertainty is the foundation of consistency. 3. An edge plays out over a series of trades, not every single trade. 4. Emotional attachment to outcomes creates inconsistency. 5. The market is neutral. Your beliefs and mindset create your results. Trading in the Zone, Chapter 12. The Trader's Edge, Thinking in Probabilities. In this final chapter, Mark Douglas brings everything together, teaching how to think in probabilities and develop a trader's edge mindset. This is the ultimate key to consistent profitability in the market. Concepts. 1. What is an edge in trading? An edge is any strategy or method that gives you a higher probability of winning than losing over a series of trades. Example, if your strategy wins 6 out of 10 trades, that 60% win rate is your edge. The key to success is trusting your edge and executing every trade without hesitation, regardless of the outcome of previous trades. 2. How to think in probabilities. Douglas outlines how professional traders view the market. Amateur trader, professional trader, focuses on individual trades, focuses on long-term probabilities, emotional when losing, detached from outcomes, hesitates and doubts, executes without hesitation, needs to be right, only needs an edge, reacts to random events, trusts the edge to play out over time. The secret is understanding that each trade is independent of the last one. 3. Accepting risk completely. To think in probabilities, you must fully accept the risk of each trade before placing it. Understand that any single trade does not define your skill or future results. Focus only on executing your edge, not the outcome. 4. The random distribution of wins and losses. Even with a winning strategy, your wins and losses will come in random sequences. 5. Building confidence and discipline. Confidence comes from accepting that losses are normal, trusting your edge through all market conditions, repeating the same process over and over without deviation. The consistency formula. 1. Identify your edge. 2. Accept the risk completely. 3. Execute your plan without hesitation. 4. Record your trades in a journal. 5. Review your trades objectively. Key takeaways from Chapter 12. 1. Thinking in probabilities is the final step to trading mastery. 2. Your edge only works if you execute it consistently. Each trade is independent. Don't attach emotions to outcomes. 4. Confidence comes from following the process, not from winning trades. 5. Mastering probabilities will remove fear, doubt, and hesitation. Final thoughts from the book. Mark Douglas teaches that the market is neutral. It's your beliefs, mindset, and ability to think in probabilities that determine your success. If you want to become a consistent and profitable trader, Trading in the Zone is a must-read book. The true edge in trading is not in the strategy, it's in your mindset. If you enjoyed this summary, don't forget to like, subscribe, and hit the bell icon for more powerful book summaries. Let me know in the comments which book you'd like us to summarize next. If you want to get a full copy of the physical book, check the link in the description below. Thank you for watching Power Books, where knowledge is power and power is yours.